Hi everyone, welcome to week 7, the last week of Accounting 250. I'm sure that you're all about ready to jump up and down with glee, but hold off. We have one more week to go through. So let's get started. We're going to be taking a look at 4 different problems, 3 out of chapter 11 and 1 out of chapter 13. The first one that we're going to be looking at is P11-26. And in this problem, what we're doing is we're taking a look at payroll. And how do we calculate payroll, and how do we journalize payroll? We have one particular employee, Lee Werner, that we're looking at to calculate what his payroll is for the entire year. Now, note that it is for the entire year. The numbers that they give you, though, may be for a monthly basis, so you'll have to calculate that based on a yearly basis, though they're giving you monthly numbers. So if you notice that there's 2 columns here, there's the calculation column, and then there's the annuals. So what I want you to do in this column is actually show me your calculation. So for instance, the salary, they say he earns $14,000 monthly. Since we're calculating it on an annual basis, we want to take that 14,000 and multiply it by 12. Okay, that's your calculation. And then here, you're going to be putting in that particular amount, which is $168,000. So I want to see your calculation here, because if you do get this number wrong, and I don't see how you calculated it, then I can't give partial credit for it, because I can sometimes see from the calculation if it was just a simple calculation error or if there's a conceptual problem. So please, in this column, show me how you calculated the number that you're going to be putting in this right-hand column. So you're going to be doing the salary first, then you're going to be doing the bonus, because this employee does receive a bonus. You want to put that calculation there. If there is no calculation to be done, then you don't need to put anything in there. I mean, if they just give you a number, then it's fine just to put it in this annual amount. Now here are your deductions, and we have federal income tax, state income tax, FICA or OASDI or Social Security, FICA Medicare, charity fund, and life insurance. Charity fund and life insurance are voluntary contributions that the employee has decided to have deducted from his paycheck. So your federal income tax, you have to remember that, again, this is calculated both on the salary and the bonus. So you want to make sure that you include the bonus when you do this federal income tax. The state income tax, you again want to do the same thing. You want to see what the state income tax was, but you also want to include the state income tax that was taken out for the bonus. So again, you want to put your calculations here, and then your amount that you calculated that to be here. Now your FICA, Social Security, OASDI, you want to use the amounts that are given in the textbook. And those amounts, it's a total, FICA is a total of 7.65%, but it's broken down in that FICA OASDI is calculated at 6.2%, and FICA Medicare is 1.45%. Now, the important thing to remember here is that in the FICA OASDI, the 6.2% is calculated up to a maximum of $117,000. So if the person makes over $117,000, which we know he does because his annual salary alone without the bonus is over that amount. So you calculate the 6.2% only on $117,000. Then your the Medicare is calculated on the full amount. It doesn't have any cap on it like the Social Security. So Medicare is taken out all the way up to the full amount of the salary amount, but only 1.45% as opposed to the 6.2% for FICA Social Security. Then the charity fund are the rates that are given to you. I believe the charity fund is 2% of the annual salary and of the gross pay. And the life insurance is a monthly amount that you have to calculate to get an annual basis. You're going to total up all of your deductions and list them here. So you're going to put all your deduction amounts here and then total them here. And then your net pay is going to be your deductions subtracted from your total gross pay. So total gross pay minus your deductions will be your net pay. Now that's for the employee payroll deductions, the employee payroll calculations. In requirement 2, we're going to be doing the employer portion, because it's important to bear in mind, as many of you may or may not be aware, that you working as an individual for a company, the employer also has to chip in and pay taxes as well on your earnings. So the government gets taxes not only from you, the employee, but also from the employer. And this is calculating the payroll expense for that the employer has to pay on this leave earner. So again, you're going to have the gross pay here. There's no calculation because you already did that in requirement 1. The gross pay for that individual hasn't changed, so you put that in the annual amount here. And then you're going to be calculating again FICA, OASDI, and FICA Medicare. Now the rate that the employer has to pay is exactly the same as what the employee has to pay. So it's 6.2% up to $117,000. And again, that's 6.2% calculated up to $117,000 of the annual salary. So when you do your calculation here, you're only going to be doing 6.2% on 117. On the Medicare, it is 1.45% of the total amount, the total gross pay. Your FUTA, or federal unemployment tax, is going to be 0.6%. Now be careful here. When you do your calculation, it is 0.6%. So you have to move it, the period, the decimal, 2 places to the left. So it's actually going to be 0.006 times the maximum that they can tax this on is $7,000. So they can't take any unemployment on salary over $7,000. The state is a little bit higher in terms of the percentage. It's 5.4% of the $7,000. You're going to put those amounts that you calculate here, and then your total employer payroll tax listed there. Now requirements 3 and 4 are simply a a journal entry for what you calculated in requirements 1 and 2. So requirement 3 is going to be the journal entry that you're going to post for what you calculated for the employee payroll taxes in requirement 1. So you're going to be using the same amounts that you calculated in requirement 1, and you're going to be listing them here as a journal entry. And here's your available accounts for that journal entry. Now remember, expenses are always debits. They're always debits. That's a normal balance. And your payables are liabilities, and those are always credits. And then the cash is the remaining amount that gets paid out to the employee. Requirement 4 is the journal entry for the employer portion. And again, we're going to be using the same amounts that we calculated in requirement 2. You're just going to list them here as a journal entry. And here's your available accounts that you're going to be using to do that journal entry. Again, remembering that an expense is a debit and payables are credits. Okay, so to see an example of this for journalizing your payroll, for the employee portion, you can refer to page 589 in the textbook. And for the employer portion, you can refer to page 591. Now those are textbook pages, not the PDF pages. Okay, the next problem is 1128, and here what we're doing is we're doing a journal entries for some warranties. So you want to review the warranty section, which is on pages 593 to 594, but they're just basic journal entries and pretty straightforward. They tell you what calculations you need to make, but review those pages 593 to 594 for warranties. And these are all of your accounts that you're going to be using for that journal entry. So pretty straightforward problem. I don't think there's anything else that I need to explain in that. Your requirement 2 is just going to be the T account for your estimated warranty payable. So whatever affected that account, you're going to be listing here. Okay. Now the next problem is 11-35, and what we're doing here is we're accounting for liabilities of a known amount. So for this, you want to refer to for 1135, you want to refer to pages 582 to 583. And what I want to point out here, so first of all, these are journal entries you're going to be listing. They give you 3 different journal entries that you're going to have to record. You have to record the actual issuance of the note payable on March 1st. That's your first entry. Then your second entry is you're going to accrue interest on the note at December 31st, 2017. Now, what's really important here is when you're calculating the interest to know the time period. that you're using. So I'm just going to tell you to take note of that. Pay specific attention to when the note was issued on March 1st, and then you have to calculate the interest that was accrued for the entire year from March 1st to December 31st. So you want to make sure you have the correct number of months there when calculating. And that's your second entry. Then the third entry on March 1st is going to be when 1 year of that payable, that note comes due, not the full note, just 1 year. So 1/5 of that note becomes payable. And you want to calculate the interest for the remaining amounts, for the remaining months. So from January to March 1st. So from January 1st to March 1st, calculate the number of months when you're calculating that interest. And these are your available accounts for your journal entries that you're going to be using in this problem. And then the final problem is 13-47. This comes from chapter 13. And you're going to be recording journal entries for two stock issuances. So one is common stock and one is preferred stock. And you can refer to page 679 for an example of common stock issued, and for preferred stock, page 682. Now, all I'm going to say is that basically the entries are pretty much the same, except you're using common stock in one and preferred stock in another. Now, in the problem itself, they give you a lot of information when they're talking about the preferred stock. And a lot of it is somewhat superfluous information. So, for instance, the percent that they give you is not really necessary. You just want to see what they issued the shares at, okay? And then what they actually sold them at. That would be your capital in excess of par. Okay, so just don't be confused by all the excess information they give you when they talk about the preferred stock. Some of that information isn't necessary. Just keep it simple. See what the par value was of the shares of stock, and then what they actually sold it for. And that would be your additional paid-in capital. Again, you can look at page 679 for the common stock and page 682 for the preferred stock. Okay, I hope that helped. I never get to really speak to you, not all of you at least. And since this is the end, I just want to wish you the very best of luck in your future classes. And it's been a pleasure having you as students in my class. I really have appreciated each one of you. Good luck to you all.